Ladies and gentlemen, good day and welcome to SIS Ltd Q1 FY’25 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Vineet Toshniwal, President, M&A and Investor Relations from SIS Ltd. Thank you, and over to you, sir.
Thank you. Good afternoon, everyone, and welcome to Q1 FY’25 earnings call. I hope you had a chance to look at our results, which were uploaded yesterday on the stock exchange and company website both. Okay. Now, I'm very happy to report that on a consolidated basis, revenue for SIS Group increased by 5.1% year-on-year basis to 3,130 crores, while EBITDA took a small hit of 1.2%, again on a YOY basis, to 137 crores. This is largely due to issues with our SXP business in Australia. Now, as a group, we continue to retain our focus on margin improvement. We have focused on margins both in terms of cleaning up customer contracts as well as rationalizing SG&A costs. The international security business was impacted in this quarter, largely due to leadership changes and loss of some profitable contracts in the SXP business, which is Australia. An absence of one-off contractual work at P4G and low unemployment in Australia, which results in labor shortages in Q1 FY’25. We would like to highlight that traditionally April to June quarter, the business in Australia and New Zealand is muted compared to Jan to March quarter, which witnesses Christmas, New Year festive seasons and major sporting events. Coming to Singapore business, Henderson continues to remain profitable through a combination of cost rationalization, shedding unprofitable contracts and new business growth. As a result, the top line of international security business grew 2.7% YOY, while EBITDA took a hit and down by 14% YOY basis due to reasons which we explained above. Now let's come to the India business, which reported the highest ever revenue of 1,868 crores in this quarter, translating to 6.8% YOY growth and an EBITDA of 94 crores, growing 6.2% YOY and maintaining a stable margin of 5%. India Security reported a revenue of 1,338 crores in this quarter, an 8.8% growth on a year-on-year basis, and an EBITDA margin of 5.4% standalone. Facility Management reported a revenue of 530 crores, 2.2% growth on a YOY basis, and EBITDA margin of 4.2%, which is actually 30 basis points higher than the last quarter. We continue to focus on margin improvement initiatives in the FM segment by weeding out low profitable contracts. The demand for integrated facility management services continues to remain strong in India. Now coming to our bank outsourcing solutions business, we are very happy to report that the business has achieved its highest ever quarterly revenue of 171 crores, which translates to an impressive growth of 12% on a YOY basis. The cash business expanded its EBITDA by 130 basis points, recording 17% EBITDA margins and a PAT of 14 crores, translating to 32% YOY growth and a PAT margin of 8.1% in this quarter. So overall, the cash business momentum is on track and efforts to unlock value are underway. We are very happy. Now let's talk about the budget, which was yesterday. We are very happy to report that the key provisions related to benefits for professionals entering for the first time in the job market, PF support being given by government to the employers, are very positive initiatives, and they are going to have a positive impact on us in the near future. So with this, I conclude my initial commentary and I hand it over to you guys for Q&A. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touch-tone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Balaji from IIFL. Please go ahead, sir.
Good afternoon. Thanks for taking my question. I had a couple of questions. So first is on the international security business. You did mention in your quarterly report that labor shortages in Australia may continue in the medium term. And, in light of that, how do you see the margins panning out for the rest of the year? As in, you have also mentioned that there has been a 3% increase in the minimum wages in Australia, and those would be passed on, as and when the contracts come up for renewal. So, when should one expect the margins to normalize going forward? That is question number one. The second question would be on the India FM piece. So there, one can see that your revenue growth is now a little over 2% YOY. While I appreciate the sequential EBITDA margin expansion, despite shedding unprofitable contracts, margins seem to have shrunk by 20 basis points on a YOY basis. While I do understand that some operating leverage benefits are yet to come through, when should one expect the margins here to normalize? Thank you.
Thanks, Balaji. This is Rituraj. So, on the first question, international security, I'd say that the labor shortage situation compounded by the fact that there has been a significant wage increase of 3%, I think has presented a complex situation before us. And I would say that basis the last management catch-up that I did a few days back, it will take 1 to 2 quarters to bed this in, which means to pass through the higher wage cost as and when they come up for renewal, and also for addressing the labor shortage issue with an aggressive recruitment program that we are undertaking at the moment. So yes, I think there is going to be two quarters of turbulence on the international security, particularly in Australia. On the India FM margins, I just say that India FM reported 3.9% EBITDA margin.
4.2.
The previous quarter was 3.9%, and this quarter is 4.2%. So sequentially, the margin is up, and our actions are underway. As we've said in the past, we are getting out of most of the contracts where we were losing money. There is a bunch of railway contracts which we are trying to, exit. But obviously, being a government tender, there are limitations, and there is only limited flexibility for vendors to step out. So, I think that said, this is ongoing, but I think the FM margins are going to be pretty much on track. And they will be moving towards the 5% mark in the coming quarters.
Thank you. That answers my questions, and all the best.
Thank you very much. The next question is from the line of Riya Mehta from Equitas INV. Please go ahead.
Thank you for the opportunity, and congratulations on good numbers in India business. My first question pertains to the number of employees we've added in security businesses in India. It's around 2,153. So, just I wanted to understand that despite the incremental employees, our revenue has not grown in the similar extent. So, what would be the reason for that?
Sorry, I'm not sure where you're picking up your data from. Could you say that again, please?
Yeah, so I think what I'm trying to understand is last quarter we've seen almost decrease in the number of employees. However, this quarter we are back to around addition of 2,000 employees per quarter, which was our. When do we see ourselves reaching that 5,000, 6,000 mark again? And also the number of branches have reduced significantly. So is this a phenomena we are looking ahead?
No. So, look, we track our revenues by branch and not by headcount. So I'm sorry, I don't have the numbers absolutely handy to tell you in terms of employee headcount. But what I can say is that if you look at our branch count, on 31st March 24, we had 152 branches in SIS Security, which as of June is 156. So we've added 4 branches. Branches in other businesses like SLV, Uni, Tech, SIS, We Protect remain the same. So security operations run 180 branches today.
I think last Q4 it was 184 and this quarter it is 177 as per your presentation.
Where are you picking that data from? I'm not sure. So if there is a typo error, I'm just looking at the MIS.
The Q1 FY'25 25 result update in the Security Solution India business.
Right. So I think there is a typo. I think coming back to the question, we have not closed any branches.
Okay.
That's the first fact. The second fact is that as far as the manpower headcount is concerned, we've had very modest growth in the India security manpower this time, and we believe that the exact reason for this under revenue linkage to manpower to billing, I'll have to check the accrued revenue count for you and come back to you.
Okay, no worries. And in terms of the explanation given that we have an annual June revision, so just wanted to understand the mechanism, how it is passed on and what were the conference charges which were there.
So the annual conference charges are close to 5 crore rupees, which we incur once a year. So it's a big impact on a single quarter. As regards to the other point you said was
Wage revision.
The wage revision is basically, it's our pay review system for the non-billing staff.
Okay. Okay. And we were talking about the incremental increase in wages for the workers, which will in turn become pass through. So when do we expect that wage hike coming in?
Wage hike by the central government or state government?
Yeah.
Well, that's impossible for me to forecast. I think what we've seen in the recent budget is that the government seems to be clearly preferring more jobs versus higher paying jobs or better paid jobs. So there's a push for creating more jobs and incentivizing that. I'm not sure what that does to labor reforms and also to, minimum wage increments that generally are passed through. While some of the states in the south have passed it through, the central government hasn't really come up with anything material.
Got it. And in terms of just like Australia, if there is a wage hike in India, we will take 1 or 2 quarters to pass it on?
No, I think there's a big difference. The Australian contracts are such that the there is a defined date in the contract when the pass-throughs can happen.
Right.
As regards to India, the mechanism is straightforward. From the date that the pay hike is effective, the minimum wage hike is effective, even if it is retrospective, we instantly pass through. There is no negotiation, there is no time lag, there is no waiting for a timetable.
Got it. And in terms of a Singapore business, how is it doing?
Singapore business, like I said, is back on feet. The business is now clocking close to $40 million in annualized revenue. It's winning new contracts, and I think it is on the anvil of turning profitable, reasonably profitable if things go to plan.
So we are not anticipating any further write-off in this business, right?
Write-off is a function of the price paid and not really the current performance of business. The write-off happened, and let me explain that again. The write-off happened because in 2019, we entered into a transaction where we bought 55-60% of a business, and we hope to build that business into a $120 million business and then buy out the remaining shares. So the auditors got us to work out what we would have to pay at the end of the 4-5 years when the business is worth $120 million as price for the remaining 40% acquisition. Obviously, that was far inflated from what really happened, which is COVID and then subsequent. So there is a gap between the initial goodwill charge that was taken in 2019 and the current performance of business as it stands today, and that is what the impairment was done for.
Got it. And in terms of a further strategy, in terms of We Protect business?
Well, like I said, We Protect business is tracking very well. It has a good pipeline of contracts. It's run rating close to 10 crore rupees on monthly billing. Monthly invoice is 10 crores, close to 20% EBITDA margin. So it's a very small business in a SIS group. We invoice roughly close to 1100 crores per month. So in that scheme of things, it's a very small business, but it's a business of the future.
Got it. And where are we in terms of timeline for demerging a cash management business?
Well, the DAM Capital has just been appointed to run the process, and documentation is more or less ready. Hopefully, in the next quarter, we'll have good clarity around that.
Okay. Got it. And any further acquisition are we looking out for?
Well, I think at this point in time, there is nothing on the acquisition front that I need to disclose.
Okay. Thank you so much. I'll get back into you for further questions.
Thank you. The next question is from the line of Gunit Singh from Counter Cycli PMS. Please go ahead, sir.
Hi, sir. Thank you for the opportunity. So, sir, our revenue since just give me a minute. Our revenue since FY'20 have gone up from about 8,500 crores to about 12,000 crores currently. But our EBITDA has remained flat from 516 crores in FY'20 to about 519 crores right now. What's even worse is that the conversion to PAT has even worsened. The PAT in FY'20 was 225 crores versus 190 crores right now. And sir, even year on year, we see that the depreciation is going up from 135 to 166 crores. And the interest payments have also gone up from 115 to about 150 crores. But, I mean, all this is not translating to a significant rise in revenues or profitability. and it's only worsening in the profitability. So, sir, I just want to understand why is this happening? I mean, and why is it not translating into better profitability? And by when do we expect to move out of this low margin trajectory?
I don't know whether you've been following us for the last few years, several quarters. We've given a flavor of how the facility management business is moving, how the international business is moving, what challenges we are facing over there, how the tax treatment works, the investment we are making in the We Protect business, which is actually driving the depreciation and interest. And compared to 2020, the interest rates are much higher today than they were. They see no signs of going down. So we've actually every quarter we've been giving a flavor of what's going on. So it's very difficult for me suddenly to give you a snapshot of what's happened between 2020 and 2024 on this kind of a call. So if you have a specific question, I'm happy to take that. But to take you through a journey of 4 years in this short call is going to be very difficult.
Yes, sir. So, brief. I mean, in 2020, interest payments were even higher than today, but profitability is low. But anyway, so to put the question in brief, I want to understand, I mean, what kind of margin improvement or steady state margins do we expect going forward? And by when do we expect to, I mean, move out of this EBITDA range of 520 CR, according to you? What steps is the company taking? And when will the investments that you have been making and all the initiatives taken by the company, when will they fructify into actual profitability growth for the company? So this is the main question.
Okay, let me take those three questions in a different order. So I think last year we broke out of the 520 EBITDA scenario. EBITDA was close to 600 last year. So that's one thing, and I think we've broken out of that for good. Though I agreed for 3 years it was flat in that 500-520 range. On profit improvement, we just few minutes back, Rituraj recounted the challenges which we are having in international business on the labor front, on certain challenges we are facing in the sudden cross protection business. So, and he said it's going to take 2-3 quarters for us to break out of that. On FM also, we just mentioned that we hope to reach the 5% range by the end of the year in another 2 quarters. So there are several actions underway, and I think in Q3 or so you should start seeing us breaking out of this particular range. And as far as the We Protect investments are concerned, yes, these are long gestation businesses. They require investment, but returns are in high double-digit range, which is much better than the rest of the business. And today we are almost 25,000 installations and rapidly growing there. So the investment over there is required for us to gain the business and install the customer's equipment, and that's the returns we get over a period of time.
All right, sir. Sir, and by when does the company expect, to reach historical margins of about 6%?
Well, like I've said, we are committed to the 6% margin range that we have demonstrated in the past, but unfortunately, it's taken more time than we had initially envisaged. If you see the security business, it's far closer to the 6% performance range that it had maintained pre-COVID. The FM business has just broken up from the 4% barrier, and I think it should tread well again towards its pre-COVID normal. As far as the international business is concerned, pre-COVID, international business was operating between 4-4.5%. It is has been in that broad range for the last few quarters, and I think it will remain there. As far as the cash business is concerned, it is roughly operating at 18% EBITDA margin.
All right, sir. That's all from me. I wish you all the best. Thank you.
Thank you very much. Next question is from the line of Chirag Philok from Ratna Traya Capital. Please go ahead, sir.
Hi, this is Sanjana. I am his colleague. Thank you for taking my question. So I have three questions. One is on the international business, sir. You mentioned three factors which had led to a lower margin in this quarter. So one is the loss of some profitable contracts in Australia, and some leadership changes, and then some job work which was there in the last quarter. So would it be possible to quantify these three factors for us? Like, if you can give some sense, what impact did it have on the margins?
Well, I think I don't have it handy immediately to give you the micro details, but this, we have tried to cite a general blend of reasons why we are facing the situation we are facing. But I'd say if you were to see what is the mother of all issues, it's actually the short staffing because of the labor market situation in Australia. Everything else is momentary. This is a continued trend which over the past many quarters has been affecting us.
Understood. And on a steady state basis, at least for this year, for the international business, what do we foresee in terms of margins?
I think you should work with the 4.5% range. That's the range in which international business is being performing generally, and I think broadly that's where I see it.
Understood. Second question is on the India security business. So we defined the market size to be of about 1,50,000 crores, if I'm right. And we also mentioned that we are not particularly targeting the standalone buildings security services. So X of that, what would be the size of the market, and what is that market growing at?
Well, it's very hard for me to answer that question for you because there is no third-party independent reliable source which I can quote here.
Right.
So, it's basically guesswork. The way we see it is that the security industry in India is today roughly 40% organized basis what the industry estimates are. And in that 40%, we basically count fully compliant operators who are basically paying all social security, and most of the large corporates, most of the listed corporates tend to work with these compliant companies itself. We have also seen in the past, I think these are just generic rule of thumbs. In the last 20 years that I have been in this industry, I have always seen this industry to be growing at 1.5x to 2x GDP development in India. So these are the two rules of thumb we use in this industry. There isn't any data source that I find reliable enough to comment on the addressable market itself.
Understood. Just one last bookkeeping question. Our depreciation sequentially has come down. So, what was the reason for that? If you can highlight. I'm comparing X of the impairment of which was there in the last quarter. So 48 was the number last quarter, I think 48, 49. This quarter it's 42. Marginal reduction, but yeah, if you can help us and help me understand.
Okay, so generally we have a policy of doing depreciation on a WDV basis, not on straight line basis. Mm-hmm. So this could be the effect of that.
Okay, understood. Thank you for taking my question.
Thank you very much. The next question is from the line of Shiv, who is an individual investor. Please go ahead, sir.
Good afternoon, everyone. Hello. So my question is around can we get some kind of a quantification around how many, I'll not say bad contracts, or I'll say contracts which are not optimum, which have not been converted into, or they are pending, like as you said, railways one. So, or we'll say, I don't know, are there any like top 3 contracts, bigger ones, which we intend to close or convert them into good contracts, and what kind of quantification we can have? Can we have some kind of a percentage? Because as an investor, what I see is that SIS is trying to convert these so-called as bad contracts into at least good contracts percentage, right? And that's what I see one of the major things in SIS. So is there any kind of quantification we can get in terms of percentage or numbers?
Well, I think, contract level commentary is very hard for me to provide. What I can tell you is that we do something called the ABCD analysis of our contract portfolio. A category contracts, B category contracts, C, and then the D category contracts which are hemorrhaging, either loss making, or they are bad pay masters, or operationally unviable to execute, etc., etc. So this is an ongoing process. At no point in time D category contracts constitute more than 10%, 12% of the entire portfolio. But even 10%, 12% of the entire portfolio not doing well is actually a big drag in a business like ours. So I told you, like for example, railways 3 years back or pre-COVID was one of the biggest segments we were actually going gung-ho about. They were spending hell of a lot of money on their cleaning efforts. They were trying to, the big mantra was clean railways, better railways. And then suddenly during COVID, when the railways stopped to operate, railways incurred huge losses in that period. They have simply flipped back, changed contracts unilaterally, changed payment and bill approval systems in a way that these, what seemed to be paradise pre-COVID became complete nightmares. Now these are 3-year, 4-year contracts. These are not contracts you can step out of. These are a lot of contracts that we bid pre-COVID but were awarded post. So, that's why I called railways out. Now, in business as in life, things like this happen. I'm not saying that railways overall is a bucket of bad contracts, for example, or IT is, or this is, or that is. There are some contracts which are sticky and not delivering for us. We have moved out from a large number of these contracts in security. That's why even though the slow growth has been slow, the margin has gone from 4% a few quarters back to 5.5% range. Similarly, in facility management, we were at 3.9 last quarter. We are at 4.2, and had it not been for the pay reviews that happened in June, this would have been a tad higher. So I think we are doing what it takes to fix it. It's taking longer than most would like, and I completely understand that, but there are no shortcuts. We can only get out of contracts when we can get out of contracts without getting blacklisted forever, or without losing favor with a particular client or in industry for long term.
Got it, sir. So this coming to this D level contracts or the D category contracts, you are saying as like approximately 10%, or I'm sorry, that number.
There is no consolidated number like that for all 1,100 crores of monthly invoice value that SIS generates. I was talking particularly with reference to the facility management business. And
okay, got it, sir. Got it.
As far as SBU by SBU, there is analysis of ABCD contracts. Unfortunately, that's not public information. That's not something I can disclose.
Yeah, got it. So just last question of mine. So this, in the public domain, one of the thing was that, like the Ram Mandir contract is also given to SIS. I'm sorry if that public note was how true it was. So those kind of contracts, those kind of government so that contract, I don't know how big it is, but is that contract by any way coming into such kind of railway category where probably it can go? It's not having good margin, how it is, because with the change of government, I don't know how it goes on.
Well, Ram Mandir contract, we made a clear disclosure about it because we were inundated with calls about our role in the Ram Mandir contract after some TV news channels covered it. Ram Mandir contract is a profitable contract. It is still with us. It is probably a 0.01% type in terms of revenue contribution. Not just the Ram Mandir contract, various other such temple trusts, ranging from the Kashi Vishwanath Trust to the Vrindavan Trust to, there's so many other temples and trusts in the country which are big buyers for security because they witness a large number of footfall. They are all important contracts from a visibility standpoint. From a contract value standpoint, they are not that material. As far as profitability is concerned, none of these contracts are loss-making. They are not in D category.
Yeah. Thank you, sir. Thanks a lot. Thank you very much. That's it from my side.
Thank you very much. The next question is from the line of Heath Vora from Guardian Capital Partners. Please go ahead, sir.
Yeah, hi. Good afternoon. So my question was actually on the impairment which we took in the last quarter. So as you said that, there was a change in the valuation, and given you guys had provided for a higher number earlier, you've taken an impairment. So is that the end of the impairment, or do we expect further impairment given the fall in the valuation?
Well, I think it's something that, we will have to go by the auditor's advice. But the gap between what we estimated as Henderson's value in 2019 and what we actually paid during COVID for the 100% acquisition, the gap is very wide. Not all of it has been impaired. So you have to understand that, I will take the exact numbers and I will send you, I'll ask, we need to send you a pack to explain this. And anybody else who wants to have clarity on it, I'm happy for you to actually go through a separate pack that we presented to our board. What you need to understand is that initially, when the deal happened in 2019, we estimated that we'll have to pay over 120 million Singapore dollars for the entire enterprise. If it had built out the way we had to pay. Interestingly, we bought the remaining 40% for a significantly lesser price because the promoter wanted to tap out. So I think the cost of 100% acquisition against $100 million plus was barely $65 million, somewhere there. And I'll give you exact numbers. This is just top of my mind. So obviously, the goodwill charge is basis $120 million. The actual payment is basis $65 million. Actual performance of the business today is a $40 million business which makes little to no profit. So there are three metrics operating here. What we envisaged, what we paid, and where the business lies today. So basis these three numbers, the auditors last year advised us that we should impair. We took the impairment. I believe what's the important thing in this? One is that I am happy to share any data you want for you to understand this impairment charge better. But the two things I want everybody to understand on this call is, number one, Henderson went from a $50-some million business when we bought it during pre-COVID to a $20-some million business during COVID because of what prevailed. Completely unanticipated. Today, the business is fixed up and is back run rating $40 million plus on an annualized basis. At its worst point, it was losing close to $5 million in terms of annual losses. Today, annual losses are zero. So it's a business that's in decent shape, much better than it was in the past. Number two, Henderson we paid $65 odd million, but the government of Singapore during COVID gave us $30 million in terms of grants. So the actual cash out from SIS standpoint for this transaction is $35 million. At this point in time, a very handsome amount of money is kept parked in Singapore to fund this business's organic and inorganic development. This business in no way is consuming any capital from the parent company. So goodwill impairment is accounting. Please understand it. Business is fine. It's not sucking cash.
Understood. Just a follow-up on that. If we had concluded it at a low valuation, why did we not take the entire impairment at the time of acquisition, as it would help with our capital employed, given, it would reduce our balance sheet size? Just wanted some understanding there.
No, obviously, because in 2019 when we bought it, we didn't see COVID coming. We thought we'd build this business organically and inorganically with our partner, and then we'll have to buy out the remainder for 40% of the company. And we had to estimate what would be the amount that we'll be required to pay to acquire that 40%, and basis that we were, the goodwill charge was made at the time of acquisition.
No, I get it. I was actually saying the second installment. When we made the second installment, which was a much lower sum which we paid than normal, why did we not take the entire write down at the impairment?
In 2021 also we took an impairment charge. When we acquired the 40% at a lower value, we took an impairment charge. We have taken a second impairment charge. And honestly speaking, I believe, from a macro perspective, and I'm again underlining the Henderson business, we've acquired 15 companies, SIS. The only business that's gone wobbly post-acquisition probably is Henderson. Okay? However, having said that, I believe that the goodwill sitting on our books overvalues the acquisitions we charged, because in the case of SLV, in the case of Unique, in the case of most assets, they were all ratchet-based creeping acquisitions where the outgoing promoter had to perform something and then we had to pay a value. In most cases, they underperformed, they went out with lower payments. Right? Now, because of this, we are sitting with a large inflated goodwill charge which artificially compresses the real return profile of this business. So honestly speaking, I know an impairment charge sort of rings alarm bells, and I completely understand that, but it's completely non-cash. In our case, it does not represent the actual health of the acquired asset, as I explained in the case of Henderson. And I believe that getting rid of some of the goodwill progressively will only do the SIS balance sheet good.
And do we have any plan how we want to do that, or it will be again based on your auditors?
Well, it's not a decision that we take unilaterally. It's based on auditors' advice and also consultations with other key stakeholders. But, I think my thinking has been articulated adequately.
Got it. And just one more thing on the international operations. You mentioned that there's a leadership change. Could you sort of give something on what was this leadership change? Why do we need that? Because I think the last quarter, the international businesses were performing. It had been one of the strongest quarter for the international business. So, or if you just could give some sort of explanation as to what that leadership change is regarding.
Well, so how do I say this? The guy who was running SXP for us, which is a $150 million business, he unfortunately came down with serious health issues. He suddenly stepped back, led to a chaos. We didn't have leadership in place for succession. We acquired inducted a CEO and a COO as a replacement, which lost us 3 to 4 months. Once both of them came on board, the COO got a better offer, so decided to step out. So that's the leadership mess that has been suggested. However, now the business is in stable hands, and the organizational rejigs are being made. They have SXP reported barely 1% EBITDA this quarter. They also had some issues on their invoicing and collections. So I think this is particularly a bad quarter for them, but it's not a bad business. Once it gets fixed up, in the next 1 to 2 quarters, it should be fine.
Got it. Thank you so much. That was my question.
Thank you very much. The next question is from the line of Riya Mishra from SKS Capital and Research. Please go ahead.
Hello. Hello.
Yes, please go on.
Yeah, thank you for giving me the opportunity. So my question is very future-looking and qualitative in nature. I understand, given the last quarter, we are trying to de-link our revenue from our headcount. Is that right?
Your voice is not clear.
Hello. Hello. Am I audible?
Your voice is not clear. Some of the words are not coming through clearly.
Okay, just a second.
Yash sir, please use your handset while you ask your question.
Hello.
Yeah, you're audible now.
Yeah, so my question was very qualitative in nature. Given my understanding of the last quarter's Concall is that we are trying to de-link our revenue growth from our headcount growth. Is that right?
De-linking revenue growth from headcount.
It's always been de-linked, my friend.
Hello.
It has always been de-linked, my friend. We are not a staffing company. We do not charge per head per month flat fee of 500, 700 rupees. That's not how we operate.
Yeah. So my question was that the V-Protect business and the cash logistics business are looking very good. So like, what are we looking forward given next 5 to 6 years? What is our target revenue contribution or margin contribution? If you can give some guidance on that.
I don't think we can give you a SBU level guidance on revenue growth.
Or even the contribution towards the total consolidated revenue, if you can.
SIS has never done that. I'm so sorry, I cannot give you revenue guidance like that.
Or even in qualitative nature as to how you are looking to expand the business, or because the margins are very good as I see.
Can you repeat that, please?
So I was just trying to get an understanding as to how.
Sorry to interrupt, sir. Your voice is not clear. Please use your handset while asking your question.
Hello.
Yeah, it's audible. Can you please say?
Yeah, I was just looking to understand how the company is planning on expanding its V-Protect business and the cash logistics business, given its attractive margin profiles and all. So I was just looking for a qualitative guidance on that, if it's not very quantitative in nature.
Well, SIS cash logistics business has, if you look at the last 5 years during COVID also, the business continued to grow. If you look at the last few years in particular, the business has maintained. If you see this quarter onwards, we've started doing a very detailed note on the cash logistics segment in our earnings note. So if you refer to those pages, you will see that it has, since Q1 of FY20 till Q1 of FY25, our cash business has maintained a 17% CAGR on revenue growth and a 48% CAGR on EBITDA growth. So the business is in good shape. They know how to grow, which has demonstrated in the past through COVID and after COVID. And I'm very confident that the outlook is going to be pretty similar in terms of organic growth of the business.
Okay. Thank you. Thank you. That's all.
Thank you very much. Ladies and gentlemen, you may press star and one to ask a question. The next question is from the line of Riya Mehta from Equitas Investment. Please go ahead, ma'am.
Thank you for giving me an opportunity. I just wanted to know when was the last wage revision which happened at the central government level?
Central government level wage revision would have happened I'd say it happens every year. Unfortunately, the last revision that happened was barely like 150 rupees. So it was inconsequential.
But when was the last, when did this happen?
The central minimum wage revision, let me just check for you. I think the central minimum wage revision would have happened somewhere pre-elections. I'll give you the exact date. I'll have to check.
Okay. So we are, it's still a year for us to see further wage hikes, right?
No, but there's two types of wages. One is the central government wages, central wage, what's called, and then there are state minimum wages. So states revise minimum wages of their own accord, and every month one or two states revise.
The DA was announced on 16th. Latest DA revision.
So latest central minimum wages dearness allowance revision happened on 6th of April. So actually it happened in the midst of election. And minimum wage hikes of states keep happening. Like Odisha has just done last month. So every month one or the other state will do a minimum wage revision.
Do we have any particular geographical concentration where we can keep on, would help us better to keep a track of those states?
Well, SIS is a highly diversified business. We get roughly 600 plus crores of monthly revenue in India, and revenue in a state. Our largest state operation would probably be Andhra Pradesh or Karnataka, and even Andhra Pradesh or Karnataka would not be contributing more than 50 crores out of the 600 crores. So there isn't, it's very hard to say, it's very spread.
And in terms of incremental manufacturing which is happening, infrastructure-led growth, so what is the growth we are seeing in that sector? I understand we are diversified, but what kind of growth are we seeing there?
Well, SIS works, one is the geographical diversification of SIS. The second is the customer segment diversification. So when India grows at 6, 7, 8% GDP and spends 10, 11 lakh crores on infrastructure, so whether it's the steel company, if you take the top 10 steel companies, we work probably with more than 5 of them. Cement, we will be working with all the major cement groups. Logistics, people who carry this, we work with them. Construction agencies, companies, we work with them. So you start at auto, cement, steel, hotel, hospital, you name it. You take the top 10, we'll be working with more than 5 of the top 10. That is how SIS business is diversified. So our dependence on a particular segment like infrastructure, for example, or manufacturing, for example, or IT services is inconsequential. For us, it's a geography, whatever is happening in that geography. If it's Odisha, then our strategy is completely to work with the manufacturing guys. If it's Karnataka, our strategy is completely centered around commercial spaces, corporate parks, IT parks.
Got it. And in terms of our business model, we charge a percentage on the entire contract per labor, or how is it?
Yes, absolutely. So, when SIS bids for a contract, it's not a headcount provision. So whether it's facility management or security, we get called in to say, okay, can you study my facility, which could be a mall, it could be a hotel, it could be a hospital, and we are supposed to go back to the client to say, okay, these are your key issues. I think this is the number of manpower you need, this is the number of cameras you need, this is the softwares you need to use. For cleaning, this is the machines you need to use, these are the chemicals you need to use, and that's the composite cost for cleaning or providing security to your facility. So that's how it operates. So,
Got it. And in terms of, do we do any residential projects?
few, very few. One of our companies, SLV, which is a Gurgaon-based enterprise, works a lot with RWAs. But SIS Security, the flagship company, predominantly focuses on core industry.
Got it. And are we seeing any direct benefits from the current budget or the entire provision on skilling and employment?
Well, three schemes that the FM announced yesterday, Scheme A, B, and C. One of those schemes is linked only to manufacturing. So that doesn't apply to us. Scheme A and C, which if you see, Scheme A talks about incentivizing the employee with 15,000 rupees for a first-time joiner. We still have to read the fine print because Madam FM has said that also benefits employers in some way. But in her speech and also in our news interviews, we haven't seen clarity on that, so we're still waiting the fine print from the department. As far as Scheme C is concerned, that's a Provident Fund linked scheme where the government is saying that it will help employer and employee by contributing to the PF. Again, the Provident Fund Department circular is not out. So we don't know exactly how that operates, because then she also says that if a person is not employed for X number of years, then it has the benefit has to be repaid, and I don't know. The news articles have not been very clear. So we are just waiting for the fine print to come out, how these schemes will operate, and then we will be in a better position to comment. But broadly said, my takeaway is that the Government of India budget recognizes the need for job creation. It recognizes the need for blue-collar job creation. It recognizes the need for incentivizing not just the employee, but the employers who can create such jobs. And if the circulars are in sync with that broad intent, then I think they will definitely be very attractive for SIS.
Got it. Thank you. That's it from my side.
Thank you very much. Ladies and gentlemen, as there are no further questions, I would now like to hand the conference over to Mr. Rituraj Sinha for closing comments.
Thank you everyone for this extended call. This is a subdued quarter in terms of results for us, primarily driven by the SIS international entity. But I would request you to kindly look at the development on the India side of the business. I think that's far more reassuring. Second point I wanted to quickly make a mention of is the budget. in the coming weeks, we will try and ascertain closer the implications of the budget, and by the look of it, it is definitely encouraging, and I hope the bureaucratic fine print is consistent with the larger intent. The third point I wanted to state is that we will be reaching out to the larger investor community with regard to our plans around the cash business in the coming weeks. So I hope to see any of you who might be interested in that. I think that's a very attractive business. It is now ready to go its own way, and we are looking to unlock value in that domain. So those are the three things I wanted to quickly sum up. Thank you very much once again for being patient and being on this call. Thank you. Bye-bye.
Thank you very much. On behalf of SIS Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.